Expiry date is not volatile by accident, it is controlled. Most traders believe expiry offers opportunity. In reality, it transfers exposure. If you trade expiry without understanding positioning, you are not trading, you are providing liquidity. Today, we decode the psychology behind expiry. Not indicators, not signals, behavior. On expiry, time collapses. That alone changes trader psychology. Premium does not behave the same way it behaves on Monday or Tuesday. Every minute carries decay, every delay carries cost. That creates urgency, and urgency reduces clarity. Retail traders feel pressure because premium evaporates faster. Price swings feel amplified. Small moves look meaningful. Noise feels like opportunity, but expiry compresses time. And when time compresses, emotion accelerates. Now understand the institutional side. Institutions do not wake up on expiry asking, where will the market trend? They ask something very different. They ask, where is exposure concentrated? Where is open interest heavy? Where is gamma sensitive? Where is liquidity thick? Because expiry is settlement. Settlement is about balance, not about trend. When price drifts too far away from large open interest clusters, risk increases for dealers, so flows adjust, hedges rebalance, liquidity is absorbed, price compresses back. To the untrained eye, this looks like volatility. In reality, it is exposure control. This is why expiry often feels confusing. You get expansion, then sudden stall, then reversal, then compression. Not because the market is random, but because positioning is heavy. And heavy positioning creates gravity. Now let us decode the 4 structural traps of expiry. First, the morning breakout trap. The open prints with energy. Volume builds quickly. Price expands 30, 40, sometimes 60 points. Momentum traders enter. Options premium spikes aggressively. Confidence rises. But what is happening structurally? Price is stretching away from heavy strike concentration. Liquidity increases. Dealers adjust hedges. Flow absorbs expansion. And momentum stalls. Breakout becomes compression. Early excitement becomes sideways decay. Second, the midday premium collapse. This one is psychological. Price may even be directionally correct, but time decay is now dominant. You are long calls, market moves up 40 points. Premium barely responds. Or worse, it decays. Frustration builds. You exit too early, but the structure never intended reward. Expiry rewards positioning, not late participation. Third, the afternoon reversal illusion. Around mid-session, a sharp move appears. It looks like a fresh trend. Retail flips direction. Call writers panic, put buyers jump in, but often this is inventory rebalancing, gamma adjustment, not new information. And once balance restores, price compresses again toward heavy exposure zones. Fourth, the last hour volatility spike. Emotion is highest here. Time is almost gone. Premium sensitivity is extreme. A 20-point move feels explosive. Retail traders believe this is the real move, but observe the closing print. Very often, it gravitates toward the highest open interest strike because settlement seeks neutrality, not drama. Now step back. Expiry is not about prediction, it is about gravity. It is about understanding where positioning is uncomfortable, where dealers are exposed, where flows will compress. So shift your thinking. Stop asking, where will price go? Start asking, where is exposure heavy? Observe open interest migration. Observe strike buildup. Observe whether volatility expands or remains stable during price swings. If IV remains stable while price oscillates, that is controlled movement. If price stretches and snaps back repeatedly, that is positioning gravity. Institutional traders respect gravity. Retail traders chase motion. That is the difference. Expiry day is compressed structure, not chaos. If you feel emotional on expiry, you are reacting to engineered positioning shifts. Calm observation wins, prediction loses. And remember this clearly, if you do not know who is trapped, you are the trap.